Welcome, future top-tier loan officer. You're aiming for that perfect 100-100 on the SAFE exam, right?
Yeah,
And that's precisely why we're here.
exactly.
This isn't just another study session. It's a dedicated deep dive designed specifically for you.
Mhm.
Our mission today is really to pull out every single vital nugget of knowledge from your core source material. Cut through the noise, deliver those surprising facts and critical insights.
That's the plan. Today, our deep dive has a crystal clear mission to meticulously unpack the essential concepts of mortgage loan products and those foundational compliance rules. We're going to leave no stone unturned, giving you the precision you need for that perfect exam score. And we absolutely understand that for the SAFE exam, sticking to the source material is, well, it's paramount.
It really is. And when we say fidelity to the source, we mean it. Like for every key definition, every rule, every official description, we're going to be teaching directly from your primary source. We'll be using verbatim quotes.
That's crucial.
And believe me, we'll be explicitly pointing out those tricky facts, the ones that are easily confused, those subtle distinctions, the commonly missed details that can really make or break your score.
Yeah, those little nuances matter.
Think of these as your high-yield points. Maximum impact. Okay, let's unpack this. So let's start by decoding the different mortgage loan products. This is really your foundational knowledge, right? The bedrock for everything else in mortgage lending.
Absolutely fundamental.
We're kicking things off with what many consider the steady anchor of the mortgage world, fixed-rate loans.
Indeed. These are, I'd say, arguably the most common type of mortgage you'll encounter. And for good reason, predictability. Our source defines a fixed-rate loan, and this is verbatim, as a mortgage where the interest rate is established at the time of closing and remains unchanged for the loan's entire life.
Simple enough, right? Rates locked.
Seems simple, but
Exactly. Now, here's where it gets really interesting and, honestly, often confused. This is a crucial distinction for your exam, so let's flag this one. While the interest rate itself is fixed, it's constant, never changes the total monthly payment, PITI.
principal, interest, taxes, and insurance.
Right, PITI. That can actually change over the life of the loan.
Precisely. And understanding why this happens is fundamental. It's not the interest rate changing, not at all.
No.
It's entirely due to adjustments in the borrower's escrow account for taxes and insurance. Think about it. Property taxes can go up or down.
Based on assessments, yeah.
And insurance premiums can fluctuate too. Market conditions, coverage changes. When those components change, the escrow payment adjusts.
Which means the total PITI payment adjusts.
Exactly. But, and this is key, the core principal and interest part, the P&I derived from that fixed rate, that stays constant.
Okay, that's a super important distinction. The rate is the rock, but PITI can still have some movement because of escrow.
You got it. Now, looking at loan terms, you typically see ranges from, say, 10 to 30 years, but the most common are definitely 15 and 30-year terms.
And a great point for the exam, remember how widely available they are. You find these terms in both conventional and non-conventional lending programs.
Yes, good point. And speaking of common things, let's talk down payments. Many borrowers aim for that 20% down, right? Mostly to avoid PMI, private mortgage insurance.
Sure, that's the goal for many.
And this is vital, a 20% down payment is not a mandatory requirement for getting the loan approved. Lenders will approve loans for qualified borrowers with smaller down payments. They do it all the time.
That's one of those facts that definitely trips people up on the exam. They test your understanding of that flexibility. And here's a specific detail to really nail down for conventional loans with low down payments. Fannie Mae and Freddie Mac.
The GSEs, yeah.
They will actually buy loans with as little as 3% down these 97% LTV loans if certain criteria are met. And this list, you need to commit this one to memory, verbatim. The interest rate must be fixed. The loan term cannot be longer than 30 years. The loan must be for a first-time home buyer. The loan must finance the purchase of a principal residence.
4 clear requirements. And it really helps with accessibility, making homeownership possible for more people.
Definitely.
And beyond conventional, fixed-rate loans are big in non-conventional programs, too. Like FHA loans insured by the Federal Housing Administration, they offer 15 and 30-year fixed rates, and you can use them for 1 to 4 unit properties.
Okay.
VA loans backed by the Department of Veterans Affairs, they come in 15, 20, 25, or 30-year terms, always fixed. And USDA loans, the Rural Housing Service ones, always fixed rates. Terms are usually 33 or 38 years for direct loans and 30 years for the guaranteed ones.
Good overview. Now let's shift to something that's seen big changes thanks to legislation. Prepayment penalties on fixed-rate loans. First, let's get the exact definition from the source. A fee charged by a lender to recover some of the interest they lose when a borrower pays off a loan ahead of schedule, most often during a refinance.
Right. And this is crucial for the exam because the rules changed significantly, mostly because of the Dodd-Frank Act. Before that, these penalties were, well, much more common.
So what's the deal now?
Now, it's critical to emphasize they are prohibited in most transactions. Specifically, they're banned for adjustable rate mortgages, ARMs, for high-cost mortgages under HWIPA.
We'll get to HAPA later.
Yep. Also banned for higher-price mortgage loans, HPMLs, and really any closed-end loan that is not a fixed-rate qualified mortgage.
Wow, so that's a lot of prohibitions.
It is. It reflects a strong consumer protection focus. You shouldn't be penalized for paying off your loan early, especially if you're refinancing to a better rate.
Okay, so given all that, where are they allowed? This is the precise detail you need for the exam because it's easy to get wrong.
Exactly. Prepayment penalties are only allowed on qualified mortgages, QMs that have a fixed rate for the entire loan term and are not classified as higher-priced mortgage loans.
Okay, fixed rate, non-HPML, qualified mortgages. Got it.
And even then, the penalties are strictly limited. You need to know this specific structure, verbatim. Years 1-2. The penalty cannot exceed 2% of the outstanding loan balance prepaid. Year 3. The penalty cannot exceed 1% of the outstanding loan balance prepaid. After year 3, no prepayment penalty is allowed.
2% in the first 2 years, 1% in year 3, nothing after that. That exact tiered structure is key.
Absolutely key. It balances the lender's need to recoup some costs with heavy restrictions on how long and how much they can charge.
Okay, quickly, let's just reinforce amortization. We mentioned PITI principal, interest, taxes, insurance.
The 4 elements.
Right. In a fixed-rate loan, the P&I portion is constant each month. But here's the cool part. How that P&I payment is allocated changes over time. Yeah, this is always fascinating. In the beginning, most of that fixed P&I payment goes towards paying off the interest, right? Only a little bit chips away at the principal.
Exactly. Feels like you're barely making a dent early on.
Okay.
But as the loan matures, that dynamic flips. Less goes to interest, and more goes towards paying down that principal balance.
So your equity builds faster later in the loan term.
Precisely. Understanding that curve is really important for advising borrowers on building wealth through their mortgage.
Okay, moving from the steady anchor to something more dynamic. Adjustable rate mortgages, or RMs. These are really about balancing risk and opportunity.
Definitely a different beast. Our source defines RMs and notes the risk, verbatim. A mortgage with an interest rate that can change 1 or more times during the loan's life. RMs are considered risky because payments can rise and become unaffordable. That last part is the core warning.
The potential for payments to become unaffordable. That's the risk.
And that risk is exactly why calculating the fully indexed rate for qualification is so critical for your exam. This area saw a lot of abuse historically, which led to major regulatory changes. Let's use the example from the source. Consumer applies for an ARM. It has a low 3% introductory teaser rate.
Got it.
The loan's margin is 3%, and the benchmark rate is at 4% when the loan closes. So the calculation for the fully indexed rate is simple. 4% index plus 3% margin equals 7%.
7% is the fully indexed rate, not the 3% teaser rate.
Correct. And here's the critical takeaway for the ability to repay rule. This is verbatim and vital. Under the ability to repay rule, the borrower must qualify based on their ability to make payments at the 7% fully indexed rate, not the lower 3% introductory rate.
Absolutely paramount. No more qualifying people based on a rate they can't sustain long-term. You qualify them on the real adjusted rate.
Exactly. It prevents that trap. Now, this ties into ARM suitability. Think about the Carter family example in the source. They plan to move in about 5 years.
Right, short-term homeowner.
Their MLO recommends a 5-year ARM. This makes sense. They benefit from lower initial payments, planning to sell or refi before the rate starts adjusting significantly. It aligns the loan with their time frame.
Makes sense. So to really get ARMs, you need to understand the parts of the rate calculation. First, the index, defined as a common metric for the cost of borrowing money.
Like Treasury bills, TUCO-R, SOFR.
Right. And the specific index used has to be disclosed on the loan estimate and the promissory note. Transparency is key. And an interesting point, a longer-term index usually means more stability for the borrower, less volatility.
Good point. Then you have the margin. This is the fixed part. It's the lender's profit and operating costs baked in. The source says a fixed percentage rate added to the index, representing the lender's operating costs and profit. It is selected by the lender, typically ranges from 2.5% to 3%, and does not change during the loan term.
Fixed, disclosed, doesn't change. That's the margin.
Correct. Now, to limit the risk of those changing rates, ARMs usually have caps. Essential for risk mitigation and definitely exam territory. You need to know the 4 types.
Okay, I'll lay them out.
First, the initial rate cap limits the first rate change. Second, the periodic rate cap limits subsequent rate changes after the first one. Third, the lifetime rate cap, the absolute maximum rate the loan can ever reach, super important.
And fourth,
The payment cap. This one's tricky. It limits how much the monthly payment can change, but not necessarily the interest rate itself.
okay, so the payment might be capped, but the interest due could be higher.
Exactly. And here's your critical warning for the exam. A payment cap can lead to verbatim negative amortization, where the monthly payment is not sufficient to cover all the interest due, and the unpaid interest is added to the principal loan balance, causing it to increase.
So you're making payments, but your loan balance is actually growing.
Yikes. It was a huge problem, but it's vital to know that current laws, especially for high-cost HOIMA and qualified mortgages, largely prohibit payment programs that can cause negative amortization. So the concept exists, but the products allowing it are mostly gone in the regulated space.
That's a major consumer protection win.
Okay, what about other ARM consumer protections and disclosures under TILA?
Good question. First, there's the Charm Booklet Consumer Handbook on Adjustable Rate Mortgages. The timing is crucial. Creditors must provide the Consumer Handbook on Adjustable Rate Mortgages to a consumer no later than 3 business days after receiving their loan application if the loan is for a principal dwelling. 3 business days. Got to know that.
Okay, charm booklet within 3 days. What else?
Specific loan program disclosures, one for each ARM product the consumer shows interest in. It needs to detail things like statement that rates payments change, the adjustment formula, how rates are calculated, adjustment frequency, and mention of future rate change notices. Lots of detail.
Ensuring they understand the specific ARM they're considering. Exactly. And about those future notices, the rate change disclosures after closing. The timing is vital again. No less than 60 days and no more than 120 days prior to the effective date of a rate change. It has to show the current and new rates and payments. Gives borrowers a good heads up.
60 to 120 days before the change hits. Got it.
And let's hammer this home one more time. Critical exam point qualifying borrowers based on low initial PSER rates. Strictly prohibited. Today, applicants must qualify based on 2 standards: the fully indexed rate, using the index at consummation, and their ability to make monthly fully amortizing payments. No qualifying on interest-only or neg-am payments.
Sustainable payments only. Okay, quick rundown of ARM types.
Sure. Hybrid ARMs are very common, fixed for an initial period 3, 5, 7, 10 years, then adjustable. Like a 51 ARM is fixed for 5 years, adjusts annually after that. Great for people planning to move or refi before the fixed period ends.
Okay, what about interest-only or payment option ARMs?
Those are no longer common. Basically, the ATR rule and QM prohibitions against negative amortization and risk layering have pushed them out of the mainstream market. You might see them in historical context, but not much current practice.
Good to know. And FHA-VAVs.
They exist. Federally backed, they have their own specific cap structures. Like FHA might have 1% initial, 5% lifetime caps, or 2 per 6%. VA often has 1% periodic, 5% lifetime caps. Still ARMs, but with government program specifics.
All right, let's shift gears completely. Reverse mortgages. Specifically, HECMs, home equity conversion mortgages, how older homeowners can tap into their equity.
A unique product for sure. The source definition is key. Loans that allow older homeowners, 62 plus, to convert their home equity into cash without having to make monthly mortgage payments. The loan becomes payable in full when the home is sold or the last surviving homeowner dies. That no monthly payment is the defining feature.
Right, so key features. Borrower has to be 62 or older.
Correct. Must live in the home as their principal residence. And critically, interest is charged and added to the debt. The loan balance grows over time, unlike a traditional mortgage.
Okay, and the types.
Generally 3. Single purpose, often low cost for specific needs, maybe from a nonprofit. Then HECM's the most common, HUD regulated and insured, and these require mandatory counseling. And proprietary mortgages, private loans, sometimes with higher limits but often more expensive.
HECM specifics are probably key for the exam, that mandatory counseling.
Absolutely crucial. A borrower must get counseling from a HUD-approved HECM counselor to be eligible, period. It ensures they understand the complexities. Also, know the maximum claim amount for 2025. It's $1,209,750. That caps the home value used for the loan calculation.
And there's a rule about initial money out.
Yes, another precise rule to remember. A lender is prohibited from releasing more than 60% of the principal limit with the initial disbursement from a HECM. Keeps borrowers from taking all the equity at once. There's an exception if the funds are used to pay off existing debt, though.
Makes sense. The Dewey example in the source sounds like a good illustration.
It is. Dewey, 67, wants to build a workshop. HECM has suggested he must get the HUD-approved counseling before proceeding. It shows the process, including typical costs like appraisal and survey, and highlights that counseling isn't optional, it's a required safeguard.
Okay, let's talk about building dreams now. Construction loans. These are for, well, constructing things.
Exactly. The source defines them as an interim loan used to pay for the construction of buildings or homes. Interim financing is short-term financing made to cover costs while waiting for the requirements of a permanent loan to be met. Interim is the key word. They're temporary.
So how do they usually work? Are there different types?
Generally, two main types. Construction to permanent loans, sometimes called single close. One closing up front, loan covers construction, then automatically converts to a permanent mortgage when the house is done. Simpler for the borrower.
One application, one closing?
Okay. Then you have standalone construction loans. Two separate deals. One short-term loan for construction, then a completely separate application and closing for the permanent mortgage once the building is finished.
Two closings. Got it. Now, there's a tricky disclosure rule here under Red Z. The waterfall logic. Critical for exam, right?
Absolutely critical. For disclosure, creditors can treat the phases as one or two transactions. But, and this is the key, the loan purpose listed on the loan estimate must follow a strict order, verbatim. The creditor must select the very first purpose that applies from the prescribed list. Purchase, refinance, construction, home equity.
We have to go down that list in order.
Purchase first, then refinance, then construction, then home equity. You pick the first one that fits.
Precisely. The Abigail example nails this. She gets one loan to buy a vacant lot and build a house on it.
So you'd think construction, right? You might think so. But because purchase comes first on that waterfall list, the MLO correctly puts purchase as the purpose on the loan estimate. Even though construction is happening, it ensures consistency. Definitely a point the exam loves to test.
Okay, next up, balloon mortgages. Known for that big payment at the end.
That's their defining feature. The source says, a mortgage that requires a borrower to make one large payment at the end of the loan term, which is typically 5 to 7 years. Borrowers usually pay the balance by refinancing. That final balloon payment is the lump sum due.
Because of that big final payment, is there usually a way to handle it?
Often, yes. They might carry a conditional refinance provision. This gives the borrower an option, if they meet certain conditions like being current on payments, to convert the balloon into a fixed-rate loan at maturity. It's a potential safety net.
Okay, and the terminology is important here for the exam, right? Something about the numbers.
Very important distinction. If you see a loan described as 525 or 723, that indicates a balloon payment with that conditional refinance option. 5-year balloon amortized over 25, for example.
Okay, 525 means there's likely a refi option.
Right. But if you see 530 or 730, that indicates a balloon feature without the conditional refinance provision. The borrower is on the hook for that big payment themselves, likely needing to find new financing. Huge difference.
Got it. 530 means no built-in refi option. And are these common now?
Not really, especially in the regulated space. Balloon payments are generally prohibited for high-cost HOA mortgages and not allowed in qualified mortgages, QMs, because of the risk. There's a very narrow exception for certain balloon payment QMs made by small creditors, but they have strict rules like a minimum 5-year term and fixed rate.
Yeah.
The regulations really limit them now.
Okay, let's touch on some products that are basically fading from the scene. Interest-only and reduced documentation loans. These used to be around more, right?
Oh yeah, definitely more prevalent before the financial crisis,
Yeah.
but now, very rare in the mainstream. Interest-only IO loans where you just pay interest for a period, no principal reduction, they've largely disappeared because of the ability to repay ATR rule.
How did ATR affect them?
ATR requires lenders to qualify borrowers based on their ability to make fully amortizing payments at the fully indexed rate. You can't qualify someone just on that smaller interest-only payment anymore. That basically removed the incentive and feasibility for most IO loans under current rules.
Makes sense. And reduced documentation loans. Low doc, no doc.
Virtually extinct for most consumer mortgages. Again, the ATR rule is the driver. It mandates verifying income and assets using reasonably reliable third-party records.
Hmm.
Low doc no doc inherently doesn't meet that standard.
So those old acronyms, NINA, CISA, NEVA, SIVA.
Good to know for historical context, maybe no income, no assets, stated income, stated assets, etc.
Hmm.
But the key takeaway for today in the exam is they're effectively illegal for most regulated lending now because they don't comply with ATR's verification requirements.
Right. Okay, let's talk about second mortgages, also called subordinate liens or junior mortgages. What's the key thing to know?
Priority, absolutely key. The source says, a mortgage that ranks in priority below the first mortgage. In a foreclosure, a second mortgage is only paid after foreclosure expenses, and the first mortgage are paid in full. They are second in line.
And this lien priority concept is crucial for the exam. The Gary and Lucille foreclosure example drives this home. Their house sells for $165,000 in foreclosure. The first mortgage is $153,000. What happens?
This is exactly what you need to visualize, verbatim. The $165,000 in proceeds are applied first to the senior lien, satisfying the $153,000 first mortgage in full. The remaining funds are then applied to the subordinate second mortgage and other foreclosure expenses.
So the first mortgage gets paid off completely first. Whatever's left over then goes to the second mortgage after costs.
Exactly. The first lien holder is always first in line. The second mortgage lender has much higher risk because they might get nothing if the sale proceeds aren't enough.
Makes sense. What about piggyback loans? That's a type of second mortgage, right?
Yes, a common strategy. It's when a borrower gets a first and a second mortgage at the same time, usually from the same lender. Often the goal is to avoid paying PMI on the first mortgage.
How does that work?
The classic example is an 80-10-10 loan. Borrower puts 10% down. They get a first mortgage for 80% of the value, avoiding PMI threshold, and a second mortgage piggybacking for the remaining 10%. It's a way to get into a home with less than 20% down without paying PMI using that second lend-in.
Okay, solid foundation on loan products. Let's switch gears to navigating foundational compliance rules. Super important for ethical lending and, of course, the exam. We have to start with the pillars. ATR and QM rules.
Absolutely. The ability to repay ATR and qualified mortgage QM rules that came out of the Dodd-Frank Act implemented under TILA, central to modern lending. Their goal, stop the risky lending practices seen before the 2008 crisis.
So they put more responsibility on the lender.
Definitely. They mandate that creditors make a reasonable, good faith determination that the consumer can actually repay the loan before they make it.
And the ATR rule is the starting point.
It's the foundation. A creditor cannot make a mortgage loan unless they consider and verify 8 specific underwriting factors. This list, memorize it for the exam, verbatim. 1. The consumer's current or reasonably expected income or assets. 2. The consumer's current employment status. 3. The monthly payment for the mortgage loan calculated using the fully indexed rate. 4. The monthly payment on any simultaneous loan secured by the same property. 5. The monthly payment for mortgage-related obligations, for example, property taxes, insurance, HOA fees. 6. The consumer's current debt obligations, alimony, and child support. 7. The consumer's monthly debt-to-income DTI ratio. 8. The consumer's credit history.
Wow, that's comprehensive, covers the whole financial picture.
It does. Then, building on ATR, you have the qualified mortgage QM rule. This defines a specific category of loans that get a presumption of compliance with the ATR rule.
Like a safe harbor for the lender.
Exactly. It offers lenders either a safe harbor or a rebuttable presumption that they met the ATR requirements, giving them legal protection. It identifies loans that meet a higher underwriting standard.
So what makes a loan a QM? There are strict criteria, right? Often framed as things QMs can't have.
Correct. This is another critical list to memorize. To be a QM, a loan generally must not have these features. Verbatim. 1. No negative amortization. The principal loan balance cannot increase. 2. No interest-only payments. The loan must require regular payments of both principal and interest. 3. No balloon payments. Generally prohibited, with that narrow exception for small creditors' QMs. 4. Loan term limit. The loan term cannot exceed 30 years. 5. Points and fees cap. Total points and fees generally cannot exceed 3% of the total loan amount.
Okay, no NAGAM, no IO, no balloons usually, max 30-year term, and a cap on points and fees. Seems designed to ensure affordability and transparency.
That's the goal. Plus, for a loan to be a general QM, there's usually a DTI threshold. The consumer's monthly debt-to-income ratio generally must not exceed 43%. That's another key benchmark for QM status.
All right, next rule. The loan originator compensation rule. Also under TILA. What's the main goal here?
Preventing conflicts of interest. Plain and simple. It's about protecting consumers from unfair steering, making sure the MLO's advice is driven by the borrower's best interest, not the MLO's commission.
Okay, so what kind of compensation is prohibited? Crucial for exam, I bet.
Definitely crucial. Two main prohibitions. First, an MLO's compensation cannot be based on the interest rate, loan program, or other terms of the loan.
So you can't get paid more for putting someone in a higher rate loan.
Exactly. It removes that incentive. Compensation shouldn't be tied to the loan terms themselves. Second prohibition. An MLO cannot receive compensation from both the consumer and another party, such as the creditor, for the same transaction.
No double dipping. Can't get paid by the borrower and the lender for the same loan.
Correct. Prevents that clear conflict of interest.
Okay, let's move to RESPE, the Real Estate Settlement Procedures Act. What's its main purpose?
The source sums it up well. ORIAS-ETA is a consumer protection statute designed to help home buyers be better shoppers for settlement services and to eliminate kickbacks and referral fees that unnecessarily increase the costs of settlement. So transparency, comparison shopping, and eliminating illegal fees.
And Section 8 seems to be the big one for kickbacks.
Yeah.
Crucial for exam.
Hugely important. Section 8, verbatim, prohibits giving or accepting anything of value in exchange for the referral of settlement service business.
Thing of value sounds broad.
It is. It's not just cash. Could be discounts, gifts, special favors. The examples are classic.
Yeah.
A lender can't pay a real estate agent for sending them a client. A title company can't give a lender below market rates for referrals.
Okay, no paying for referrals and settlement services.
Okay.
Got it. What about Section 9?
Section 9 deals with title insurance. Also crucial for exam. It protects the buyer's choice. This section prohibits the seller of a property from requiring the home buyer to use a particular title insurance company as a condition of the sale. Buyers have the right to choose their own title provider. The seller can't force you to use their preferred title company.
Buyer's choice for title insurance. Good protection. And Section 10.
Section 10 covers escrow accounts. Also see crucial. It sets limits on how much money a lender can require a borrower to keep in escrow for taxes, insurance, etc., prevents lenders from holding excessive funds.
Is there a specific limit, like a cushion?
Yes, and you need to know the specific number to remember. The maximum cushion allowed is a lender can require a cushion equal to no more than 1/6 or 2 months of the total estimated annual disbursements from the account.
1/6 or 2 months worth. That exact fraction is key.
Absolutely key for the exam.
All right, let's dive deeper now into those special loan categories that trigger extra protections. Starting with high-cost mortgage loans under HOPE, the Home Ownership and Equity Protection Act.
Right. HOPA flags loans secured by a borrower's principal dwelling, but not reverse mortgages that hit certain high-cost thresholds. These are loans Congress felt needed extra scrutiny and protection because they could be predatory or just very risky for borrowers.
So, defining a high-cost mortgage is all about hitting those thresholds. Critical exam knowledge, I assume.
Absolutely critical. A loan becomes a high-cost mortgage if it meets just one of these triggers. Pay close attention to the numbers. First, the APR threshold. For a first lien mortgage, the APR is more than 6.5 percentage points above the average prime offer rate, APR, for a comparable transaction.
6.5 points over APR for a first lien.
And for a subordinate lien mortgage, the APR is more than 8.5 percentage points above the APR for a comparable transaction.
8.5 points over APR for a subordinate lien. The Landon example shows his $240K loans APR is over 6.5% above APR. Boom, it's high cost.
Exactly. That triggers all the HOPA rules. Second trigger, the points and fees threshold. These numbers are for 2025. They vary by loan size. For loans of 26,968 IS or more, the points and fees exceed 5% of the total loan amount.
Over 5% points and fees for larger loans.
And for loans of less than $26,968, the points and fees exceed the lesser of 8% of the total loan amount, or $1,348.
Okay, higher percentage or a dollar amount for smaller loans. Got it. Third trigger.
Prepayment penalties. A loan is high cost if the loan includes a prepayment penalty provision that is in effect for more than 36 months after consummation, or if the prepayment penalty exceeds 2% of the amount prepaid. So a penalty lasting too long or being too big can trigger HEPA by itself.
Even if the APR and fees are okay. Wow.
It's a strong protection. And remember, Dodd-Frank expanded HEPA's scope. It's not just refis anymore. It covers purchase loans, construction, HELOC, closed-end home equity. Much broader now.
But there are exemptions important for the exam.
Yes, HOPA doesn't apply to reverse mortgages, bridge loans for initial construction, loans from housing finance agencies where they are the creditor, and USDA loans. Need to know those exclusions.
Okay. What about HOPA Disclosures and requirements. Timing.
Crucial timing. Special HIPAA disclosures are due at least 3 business days prior to the consummation of a mortgage, a mandatory cooling-off period.
Can that be waived, like in an emergency?
Yes, but the procedure is very specific. Detailed requirement for exam. For a bona fide personal emergency, the borrower must give the lender a dated written statement describing the emergency. Pre-printed forms are not allowed. The statement must be signed by all parties who are entitled to the waiting period. They have to write it out themselves, describe the emergency, and everyone signs. No lender forms.
Very strict waiver process. What disclosures are required?
The special HIPAA disclosure is key. It has that stark warning, verbatim. You are not required to complete this agreement merely because you've received these disclosures or have signed a loan application. If you obtain this loan, the lender will have a mortgage on your home. You could lose your home and any money you have put into it if you do not meet your obligations under the loan. Very direct language. Also required. Notice of balloon payment, if allowed. Statement of total amount borrowed for refis. Notice about insurance premiums to prevent packing. And a variable rate disclosure for ARMs showing the max possible payment.
And there are affirmative requirements too, things the lender must do.
Yes. Evaluate ability to repay, good faith third-party records. And a huge one, unique to HIPAA, counseling. Critical requirement. Before closing a high-cost mortgage, the creditor must verify the borrower has completed counseling with a HUD-approved counselor.
Mandatory counseling before closing a HIPAA loan.
Mandatory. Creditor can pay but cannot steer the borrower to a specific counselor. Ensures independent advice. Also, a notice to assignees is required, telling future loan buyers it's a HIPAA loan.
Okay, now the big list. HIPAA prohibitions. Lots of exam points here, I bet.
Absolutely. These are practices deemed harmful and are banned for high-cost loans. Let's break them down. Prohibited lending terms first. Balloon payments. Generally not allowed. Very narrow exceptions. Negative amortization. Forbidden. Advance payments, paying more than 2 future payments from loan proceeds. Prohibited. Increased interest rate after default. Nope. Improperly calculated rebates, less than actuarial. Not allowed. Prepayment penalties. This is key. Not allowed under any circumstances. A complete ban, unlike other loan types. Prepayment penalties. This is key. Acceleration of debt. Prohibited except for specific reasons like fraud or failure to pay.
Okay, that's a lot of banned terms. What about prohibited lending practices, actions the lender can't take?
Right. Direct payments to home improvement contractors, unless joint pay or escrow, prevents collusion. Loan flagging defined as the repeated refinancing of a loan within a short period of time. Specifically, refinancing a high-cost mortgage within 12 months of origination is prohibited unless it is in the borrower's interest. Prevents churning loans for fees.
Refinancing a HIPAA loan within 12 months is generally banned.
Unless it demonstrably benefits the borrower. Also prohibited. Financing points and fees, rolling excessive costs into the loan, lending without regard to repayment ability reinforces ATR, lending without pre-loan counseling reinforces the counseling requirement. Also, recommending default on other loans, charging loan modification or deferral fees. Charging excessive late fees, the rule is specific. Late charges may not exceed 4% of the amount of the payment past due, and a charge may not be imposed more than once for the same late payment. A payment must also be late by at least 15 days. Need to know that 4% and 15 days.
4% max late fee, only a 15+ days late, only charged once per late payment. Got it.
Also banned. Charging fees for payoff statements, usually. And evading HIPAA, trying to structure the loan to avoid the rules. It's a comprehensive set of prohibitions.
Okay, deep breath. Now, higher-priced mortgage loans, HPMLs. Key distinction first. These are separate from HIPAA loans, right? Different category, different rules.
Crucial distinction. Don't confuse them. HPMLs are a step below HIPAA in terms of risk cost, but still trigger extra protections because they're priced higher than average prime loans.
So defining an HPML is again about thresholds, critical exam knowledge.
Absolutely critical. An HPML is a closed-end loan on a principal dwelling where the APR exceeds the APR by specific points. For first lien loans, 1.5 percentage points when the principal amount does not exceed the conforming loan limit.
1.5 points over APR for conforming first liens.
And 2.5 percentage points when the principal amount exceeds the conforming loan limit, i.e. jumbo loans.
2.5 points over APR for jumbo first liens. Makes sense? Higher threshold for bigger loans.
And for subordinate lien loans, 3.5 percentage points or more.
3.5 points over APR for second subordinates. Got the thresholds. What requirements do HPMLs trigger?
2 main sets of special requirements. First, establishment of an escrow account. Crucial details here. Mandatory for, quote, most first lien HPMLs. A creditor must establish an escrow account for property taxes and homeowners insurance before consummation. Helps ensure those critical bills get paid.
Mandatory escrow for most first lien HPMLs. For how long?
Minimum maintenance. The escrow account must be established and maintained for a minimum of 5 years. After 5 years, the consumer can request cancellation, but only if the unpaid principal balance is less than 80% LTV, based on original value, and they're current on the loan.
Strict conditions for cancellation after 5 years. Are there exemptions to this escrow rule? Important.
Yes, important exemptions. No mandatory escrow for subordinate lien HPMLs, co-op shares, initial construction, bridge loans, 12 months, reverse mortgages, certain common interest community properties with master policy, and loans from qualifying small creditors in rural underserved areas.
Okay, what's the second set of HPML requirements? Appraisals.
Yes, special appraisal requirements. A creditor can't make an HPML without getting, before closing, a written appraisal of the property to be mortgaged. And the appraiser must be certified or licensed in the state and must conduct a physical visit to the interior of the property.
Interior physical visit required for HPML appraisals. Ensures accuracy. What about timing?
Disclosure timing. A written notice about the appraisal must be given no later than the 3rd business day after a creditor receives a consumer's application for an HPML. And a copy of the appraisal itself must be provided no later than promptly upon completion or 3 business days prior to consummation, whichever is earlier.
Giving the borrower time to review. Exemptions here too.
Yep. Exemptions from HPML appraisal rules, qualified mortgages, mobile homes, boats, trailers, initial construction, bridge loans, 12 months, reverse mortgages.
Okay, now the big one. The special requirement for 2 appraisals, the anti-flipping rule. Critical for exam.
Extremely critical. This targets rapid property flipping at inflated prices. A creditor needs 2 written appraisals before closing an HPML to finance a principal dwelling purchase if certain conditions are met. It's required when the seller acquired the home 90 or fewer days prior to the consumer's agreement to purchase it, and the price at which the consumer has agreed to purchase the home is 10% or more than the price paid by the seller.
Okay, seller owned equals 90 days, price increase equals 10%.
Or the seller acquired the home 91 to 180 days prior to the consumer's agreement to purchase it, and the price at which the consumer has agreed to purchase the home is 20% or more than the price paid by the seller.
Seller owned 91, 180 days, price increase equals 20%. Those specific timeframes and percentages trigger the 2 appraisal rule.
Exactly, and the requirements for those 2 appraisals are specific too. The same certified or licensed appraiser may not perform both appraisals. Ensures independence. One appraisal must analyze the price difference, market conditions, improvements, and crucially, the creditor may not charge the consumer for the second appraisal.
No charging the buyer for that second anti-flipping appraisal. Good to know. And there are exemptions from this rule too.
Yes, important ones. No second appraisal needed for purchases from government agencies, foreclosure acquisitions, nonprofits, inheritance court order acquisitions, employer relocation agencies, certain service member situations, federal disaster areas, or rural areas. Lots of specific exemptions where flipping is less likely.
Phew. Okay. Wrapping up with some TILA core concepts and essential operational knowledge. Precision matters here. First, business day.
Yeah.
Absolutely critical for the exam because it's confusing, right? 2 definitions.
That's the tricky part. TILA has 2 distinct definitions, depending on the context. You have to know which one applies when. The general definition. That's for timing initial disclosures, like the loan estimate. It's any day on which the creditor's offices are open to the public for carrying on substantially all of its business functions. Basically, when the lender is open for business.
Okay, general definition, lender open for business. What's the other one?
The rescission-specific definition. This applies only to the 3-day right of rescission. It's more precise. All calendar days except for Sundays and legal public holidays.
All calendar days except Sundays and federal holidays. So Saturdays count for rescission.
Saturdays count for rescission. Huge difference. You must know which definition applies where.
Got it. Let's talk about that right of rescission, the cooling off period. Crucial for exam.
Absolutely crucial. Applicability first. It applies only to loans secured by a borrower's principal dwelling, such as a refinance or a home equity line of credit, HELOC. It does not apply to purchase transactions. Key point. Not for purchases, only applies when you're putting a lien on a home you already own.
Refis, HELOCs on your main home. Not purchases. How about the notice?
Notice requirement. Each person with an ownership interest in the property must receive 2 copies of the Notice of Right to Rescind. 2 copies to every owner.
2 copies each. What happens if the lender messes that up? like only gives one copy or misses an owner.
Big consequences. This is a critical detail. If the creditor fails to provide proper notice, correct form, 2 copies to each owner, the rescission period gets extended dramatically from 3 business days to 3 years.
3 years, wow. That's a massive liability.
Huge. And TILA violations in general can lead to serious penalties: damages, court costs, attorney fees, even criminal charges for willful noncompliance. These rules have teeth.
Okay, last operational piece. Record retention. Keeping the paperwork straight. Critical exam knowledge on the timelines.
Definitely need to know these durations, verbatim from the source.
The retention period for the closing disclosure after consummation, as required by TILA.
The retention period for loan estimates and records demonstrating compliance with the ability to repay ATR and qualified mortgage QM rules after consummation.
The retention period for records related to an application after notifying the applicant of action taken, as required by the Equal Credit Opportunity Act, ETUA.
5 years for CD, 3 years for LEATR QM compliance, 25 months for EQN application records after notice. Gotta memorize those specific numbers.
Exactly. They ensure accountability and traceability.
Okay, finally, let's do a super quick essential terminology review. We've hit most of these, but reinforcement helps. Financial loan terms: amortization, DTI, discount point, equity, escrow account, foreclosure, fully indexed rate, LTV, negative amortization, PITI, promissory note, securitization. Just be comfortable with what they mean.
Market party terms: conforming loan, conventional loan, primary market, secondary market, servicer subprime. Know the players and loan types.
And disclosure legal terms: APR, finance charge, loan estimate, closing disclosure, rescission. And let's just reiterate that key difference. Loan estimate is the initial good faith estimate of costs,
While the closing disclosure is the final actual statement of costs at closing.
exactly. LE is estimate, CD is actual. All right, you have just taken a really comprehensive deep dive into mortgage loan products and foundational compliance rules. We've broken down fixed versus adjustable rates all the way through ATR, QM, HEPA, HPMLs, RESPA, TILA.
We really focused on those details that often cause confusion and highlighted those verbatim rules and definitions you absolutely need for the safe exam.
Yeah, remember, getting that perfect score. It's not just memorizing, right? It's understanding how these pieces fit together, why these rules exist to make lending responsible and compliant. We've tried to give you those precise, factual building blocks straight from the source.
Exactly. The facts are the foundation, but understanding the context makes it stick.
So, as you keep studying, keep pushing towards becoming a licensed loan officer, here's something to think about. How will truly understanding the spirit behind these rules, going beyond just memorizing the words, how will that actually change how you serve your clients? How will it help you build trust and ensure you're always practicing ethically?
Good question to ponder.
Let that question linger as you hit the books again. Until next time, keep diving deep.